What is going on, everybody? Welcome to Cardone Corner. Today it is Chris Inks and I. Gary is not here, although technically he's in the same building as I am. Gary and I are actually at the SALT conference in Wyoming, specifically Jackson Hole, which, by the way, has so far been an excellent conference, an excellent experience. We had dinners last night, really good networking, and I believe they're literally just opening it up now as we speak. Of course, here, what time is it here? Here it's 10 o'clock, so they opened it up at 9:30 with Scaramucci speaking, Anthony Scaramucci, and one of the co-founders or heads of Kraken. So Gary's right downstairs kind of networking and talking to a bunch of people, but we are still here live with you. What's funny, Chris, is when we pulled up on Gary's airplane to the airport in Jackson Hole, all the airplane slots were full because all these people are here for the FOMC meeting. Yeah. I thought that was kind of funny because I didn't realize that until Gary's like, hey, we're going to Jackson Hole. I was like, oh, that's where the next FOMC meeting is, right? So just seeing all the very nice private jets, I was like, wow, these government people must have a lot of money. I was like, it was very entertaining. Of course, Gary's able to tell me, oh, that jet's that jet's that, just naming them off, how much they cost. So and then my first time in Jackson Hole, and really I don't get out to the West Coast very often at all. So I'm just enjoying being in the atmosphere. I mean, just looking at the mountains and everything. I mean, I'm from Florida, right? Our tallest,
Florida, right?
Yeah, our tallest mountain is like 10 feet, and that's what we call a mountain. So I'm super glad you're here with us, Chris. I do appreciate you coming on. I know for the title, I want to talk about the FOMC meeting, maybe some things that you're expecting. I've been reading a lot of articles on Real Clear Politics about what other people are thinking is going to happen. I was listening to Jeffrey Schneider 2 days ago, or maybe even yesterday, talking about what they think the Fed's going to do. So one, just welcome, Chris. Thank you as always for hanging out with us. But then two, let's talk about the FOMC meeting first. What are your thoughts? How's the trajectory looking? All the good stuff.
Yeah, I mean, again, other than the slight blip with the unemployment numbers earlier this month, I mean, other than that, everything's been going the way the Fed needs it to go. Again, everybody, we're looking at that inflation and how it's doing, and it continues to drop down. That doesn't mean prices are going to continue, and prices are going to drop generally, because we're talking about, it's a year-over-year increase. It's just not at the same rate it was, right? So, if we look back just over a year ago, we were something like 9. We were up pretty high, and we've had a significant pullback since then. And so, the Fed watches unemployment and it watches, inflation both at the same time there. Again, we did have what I believe is going to be an aberration for unemployment this last back here at the beginning of the month. We popped up to 4.3%. I've given my thoughts on that as far as believing it was just kind of like a one-off, right? I don't believe it's going to be this continuation thing. And so, and to kind of confirm that, we looked at the initial jobless claims over the last 2 weeks, each week. And both of them, came in soft. Both of them were less employment claims, initial unemployment claims than what was expected. And, the second week was lesser than the first week even. So we're seeing those initial jobless claims kind of dropping off there. And so that makes the Fed feel better, right? You get that.
Yeah.
And then the Fed watches inflation, and inflation continues to drop its way down there. And so when we look at all that, everybody got excitable, whatever it was, August 5th or whatever, that Monday with the jobs thing. Well, the Monday after the jobs, when we had the drop, and everybody immediately went, oh my God, we're going to get, a 50 basis point rate hike in September. We should do an emergency. Is the Fed going to do an emergency kind of rate hike right now? And they should. And, of course, I kind of talked about, no, that wasn't a good idea and whatnot. And so now, as we look at it, we can look at the, what do you call it there? The U.S. rate futures, basically Fed watch tool there on the CME. And, at the time, it was, at one point, I think it gotten up to like 90% probability, they thought, of a 50-point rate hike there in September. And so now it's dropped back down. Now we're back down to about a 75% chance of a 25% rate hike in 25% chance of a 50-point rate hike. So a 50 basis point hike. So I think we're good. I think, we'll come out of here. I don't think they'll be overly hawkish. We don't want that. We want them to sound kind of dovish, just to kind of lead into that 25 basis point drop. But, at the end of the day, really, at this point, 25 basis points really isn't enough to do a whole lot of anything. It's more of a,
it's a signal.
Yeah, it's more of a look. We're kind of doing a little something here, but it's not going to have it shouldn't have any huge major impact on things. But it's how do people, we always talk about this. It's how do people perceive what's happening versus what's actually happening. And that's kind of where we're at with all this, So as long as we get, the 25-point cut coming in, I think the market, it just continues to run as it's been. Everybody always talks about the Fed coming out, and surprising. They're like, oh, the Fed's going to come out surprised. Well, the Fed doesn't want to do that, right? The Fed wants the market to not be surprised, because if you're surprised, you're going to do something, and you're going to do something significant in a short bit of time, which is going to cause a lot of chaos on their end. So they don't want to do that, right? So you have a lot of times you'll have, Powell say one thing, and then you'll have one board member a week later say something maybe a little bit different. Another board member come out 3 days later and say something slightly different. And it tries to limit the overall harshness of whatever's, being said out there. Because again, if the Fed comes out and surprises, the market does not like surprises. The market likes stability. And because again, if they came out and they all of a sudden did something significant, you and I and other traders out there are going to get in there, investors, and probably, depending on how significant it was, we're going to do something significant in return. And, that just causes a whole bunch of chaos in it. So it makes their job a lot harder. Not that I necessarily think that the Fed really has much control over the things they say they do, but, their belief that they do, ends up making what they're trying to do much more difficult. And, it's just not a good thing there.
Fibaswamy says the Fed follows the market, not the other way around. Do you think that's true?
Yeah. Again, I believe that, the market is the leader in all things. It's the first place that people put their emotions, their thoughts, right? If people are scared, they're going to pull money out. If people are feeling okay, they're going to put money in. It is the single fastest way that we can understand what society is really feeling, right? What the market's really feeling. Is through, however the market's going at that time. So yeah. And the Fed, I've said this lots of times before, the Fed is always, is always behind, right? It's always playing catch up. It's always reacting. It's never proactive. It's always reactive on what's going on out there. So yeah.
Can you pull up the CME tracker? Because that was another thing in the comments. Someone wanted to see the CME tracker. And while you're doing that, it's interesting because you learn how much what the Fed does is, maybe this is to your point, I think psychological beyond anything else, right? Like when you're moving basis points, not because, you think it's actually going to have an effect, but because you need to tell the people that, hey, this is where we think the economy is doing, or hey, look, we are doing something. Right? Like that just becomes a game of psychology. I remember one of the most important lessons I learned in my economics class was we were taking macroeconomics. My professor was talking to us about how the Fed's job is to control inflation. And they were saying how when the Fed says something, just saying something can impact inflation, or just saying, hey, inflation is bad, will choose how people spend, which will then create like a death spiral sometimes. So I was like, wait, so is the Fed incentivized to sometimes lie or kind of promote not the accurate truth if they want to get to a certain inflation rate that they desire? And he's like, well, technically the incentive is there. Right now, I'm not saying that's what happens, but it taught me very early on that, a lot of what the Fed does is, in my opinion, social psychology more than real economic practice. I don't know if you would agree with that, though.
Yeah. So a couple of points there. One of the things I've said often is that the Fed, the best tool, the biggest tool the Fed has is its mouth. It's what it says. So they don't want to have to interfere a lot. I mean, if you're in their position and you know that when you interfere, it's going to cause potentially, things to happen because, the economy is this big, huge thing, right? You push one little lever and it flips a whole bunch of other things. And all those other levers that end up flipping as a result end up flipping other levers, right? So you can create this kind of butterfly effect just by doing something small. So the Fed doesn't want to have to be involved more than they actually feel like they have to, because they understand that the more that they get involved, the less control they're going to have over that outcome, right? Yeah. And so, the Fed's going to get out there and they're going to talk a lot. They're going to say a lot of things to try and convince you to do the things that they want to see you doing without them actually having to get in there and really kind of, put their wrench in there and start messing with it. So from that standpoint, yeah, that's something that I'm always pushing when I'm talking, about the Fed and what's going on. The other thought is this idea of economics as more of a social thing. And that's really, economics today, the way it's taught, generally leans toward a lot of mathematics, right? So it's econometrics, basically. That's the big push. And so government uses this thing because by giving these economic events numbers and formulas and stuff, then they can go, okay, well, we need to do this policy to make these numbers do this, right? So it kind of gives support for whatever part of government, or the Fed or whatever they want to do. Economics really has always been a social science, more so, right? It's this interaction between you and me, right? The price of a good, the value of a good is not determined by some intrinsic something or whatever. It's, I have this right now, you want it. Are you willing to pay what I'm willing to sell it for? And if we do, we have a transaction. And at that point in time, that's the fair value of that thing, that, that widget that we're moving between us. And so, econometrics really, I'm not a big fan of it. I understand what they're doing, but it gives, when you're a policy body, when you're the Fed, when you're some government agency, it makes it too easy for you to say, oh, well, look, we have to get involved because this, and that. So yeah, at the end of the day, economics really is just this interaction between you and I, and whatever we decide in that interaction. And that's the best, if you focus on that more than on the econometrics, I think you get a much better general feel for what's going on with things.
I agree 100%. So you want to go over whatever this chart is we're looking at, Chris?
Yeah, so this is the CME FedWatch tool, and basically this is your market participants betting, with their money on whether they believe, that you're going to have a rate hike or a rate cut, and how much of one, right? And so this right here, the target rate.
A little bit on that.
Do what?
Are you able to zoom in a little bit on that?
Let me see here. I don't know. Can I do that here? I'm really not sure how to zoom that in, unfortunately.
Can you do control plus or command plus?
Control plus, is that what it is?
Work. That's okay. Yeah.
Let's see, control plus.
Oh yeah, that would be.
Oh, awesome. There we go, man. You're the man. Look at that. All right. There we go. Okay. So yeah, so when you look at this is the target rate probabilities for 18th of September for the next Fed meeting, right? Coming up here. Yeah. Let me go ahead and move that in there a little bit more now. All right. And so what this shows you here, it says the current target rate is 5.25% to 5.5%. That's currently where we're at. So what this is showing us is that there's a 73.5% chance based on the market's views of what's coming up, whether they're going to have a rate cut and how much it's going to be, of a target rate of 5 to 5.25. So basically just 25 basis point cut. There's a 26.5% chance that you're going to have 50 basis point cut. And so that's what we're looking at. And so again, if we had looked right after that Monday, August 5th, this 50 basis point rate cut was way up here, somewhere like 80, 90%. And so, you had this down like around 20% for just a quarter of a point. But as things have gone on, we've had 8 solid days of the S&P rallying. We've totally overcome all the August losses. We're nearing, I think we're pretty close to the all-time high right now. And so all that coming in and no continuation of the fear that was there on August 5th when it happened had everything changing so that they changed, basically what they were bidding, right? Where are their, bets going? Where's their money going? And so their money has changed now, again, back up toward that 25 basis point basis point cut coming up here in September. And again, that's what I've been talking about for a few months at least. And, it's the thing that makes the most sense in terms of, the Democrats. It's a somewhat positive kind of thing. They can come up here and say, look, interest rates are coming down because of us and blah, 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 and this is what any sitting president does, whenever it comes time for the re-election coming up, even though, of course, this time Biden's out and Kamala's in. But Kamala's going to jump in there and say, look, as Democrats, this is what we've done. And aren't you glad that we're here doing this for you? So
can you, Fibboswamy said, click into November. Can you do that?
Yeah, right here. We just click this one up here. This shows almost a 53% chance right now of a 4.75 to 5. So basically, another quarter of a point rate cut for November is what they're suggesting. About almost a 40% chance, so pretty close of actually getting a 50 basis point cut, and then even the 7.5% for 75 basis point cut there in November. So it just as these things, as you get closer to when you're further out, you're going to get more extremes. You get people thinking wider ranges of ideas, but as you get closer to the date, it stays much more, I don't know, what do you want to say, civil, or much more likely, right? Much more correct, because there's less going on, right? So the longer term you go out, the more things that could happen. When it comes in November, that's right there before the elections. What are we going to do there? But again, there's a lot of lingering what ifs. People are still a bit scared because of August 5th. And so still trying to find reasons for why, that was just the start of a new bear market, of the recession, of whatever. So, until either prices is, until the index is either printing a new all-time high or we get some more solid information coming in, people are still going to be worried about that still coming down.
Can you walk me through some of the basics and tell me why they're looking at cutting rates and what rate cutting is supposed to do?
Yeah. So, when we're looking at the economy and you want to spur action, right? You want to get people to do things. You have to make it easier for them to do it. So what do? You drop the interest rate, right? If you cut the interest rate, it makes it cheaper to borrow money. And, as it gets to a certain point, more and more people are like, okay, yeah, that's a point at which I'm feeling pretty good about being able to pay that back. And, we've got these plans we want to do, and this makes sense here. So, when you're cutting that interest rate, it encourages, or it's supposed to encourage investment, it's supposed to encourage people doing things. You're raising the interest rate as they did there coming out of COVID. There's quick, huge, big interest rate hikes there. The idea is to get you to stop spending, right? To make it more expensive. Because again, as the cost of credit goes up, again, we're a debt-based economy, right? We're a debt-based country. So we need credit. We need credit expansion to keep it going. But if credit expands too fast, people have too much money chasing the same goods, prices go up. And so you kind of cut those rates, people stop borrowing money, or you raise the rates, people stop borrowing money. They have less free money to spend on the goods, and prices should slow down on their rally there. So, as we get into here, everybody's kind of talking about grocery prices and other things right now. And so when you look at the businesses behind that, who are often borrowing money for either expansion or production or or whatever they're doing, as you kind of lower those interest rates, that should encourage them to continue it up and hire people and all those things. That's the general idea.
So the assumption is that the Fed has been raising rates in order to combat inflation, and that my assumption is with the recent inflation numbers, they're saying, "Hey, actually, we've beat inflation, so we can start cutting back." Is that what they're telling us?
Yeah, so they're looking at, the Fed's had this magical 2% inflation number that they've wanted to keep forever. And, if you watch them after the GFC there in 2008, stock market bottomed around March of 2009. If you watch since then, what you'll notice is coming up into the pandemic, they had a hard time even getting 2% inflation. They actually had two bouts of a little bit of deflation coming in around 2015 or 16, and then a run again about 2019. And then the pandemic hit. They started printing money left and right. And then, of course, interest rates shot up there. And so they look to keep that 2%. That's always been their thing they want to do. And the reason being for that, again, is, we're a debt-based economy. So we have to have credit expansion because you don't want to borrow money today that's going to cost you more to pay back tomorrow, or even the same. You want to pay back with cheaper dollars, right? So if you have that little bit of inflation going, it erodes the value of the dollar, but you're paying with cheaper dollars in the future for whatever you're borrowing today. And so, now they see this coming down. It's coming down. It's like at 2.8, 3.2%, depending if you're looking at the overall piece, overall CPI or the core CPI. But it's right around that 3% area. And so they're saying, okay, well, now that we've done this, it may be sufficiently tightened enough that we can loosen up a little bit without having to worry about it taking off again. And that's what they're trying to do at the moment, because you can't keep it up high, right? You keep it up high forever. Eventually, people are tapped out. People are hurting. People are, a lot of people are hurting right now with it being what it's been for so long. So that's the idea. The idea is hopefully to have slowed that inflation enough that when you take your foot off the brake a bit and you kind of cut the rates a little bit, that it won't just take off on you again. You get some kind of double inflation pop there.
Correct me if I'm wrong, but I've heard before that traditionally when the Fed's raising interest rates, when they decide to start cutting interest rates, that's a sign that there's a recession or it's a trigger of a recession. Have you heard that before?
Yeah. So if you think about it, most people are behind on this understanding. They think that the cutting of rates actually leads to recession. Well, no, actually the recession is usually in when that happens. Now, again, as with any other way we look at, the economy and we look at indicators and things, we have to understand what is the reasoning behind what's going on, right? Is the Fed cutting rates because they have to, because everything slowed down so much that they actually have to encourage investment again, or are they cutting it just because it ran up where it was and then they have to just they're just pulling it back a bit? There's differences in that reasoning, and most of the time, that in the past historically, most of the time it's been that, okay, well, we're already entering into a recession, which means companies are laying off people. Companies are coming in. They're not expanding. They're consolidating. Production's dropping. All these things are happening already. And again, that's why we enter into the recession, right? That's because people aren't spending much, so as much, so the companies aren't producing as much. And if they're not producing as much, they don't need as many employees, so they lay off people. Unemployment goes up. You've got less money coming in. And it kind of feeds on itself for a while. So that recession has already started, usually when the Fed is cutting rates. And so then they cut the rates and they have to get it to a point. It's not like the first cut, 25 basis points, and all of a sudden everybody's buying again. No, you have to get down to an area where people feel comfortable enough to say, okay, I can go ahead and take this risk, and take out some loans to do the things I need to do, take out some credit. So yeah,
that's where they raise the interest rates to cause a recession.
Say that one more time.
Do they raise the rates to cause a recession?
No. Again, they raise the rates because inflation gets going. So the economy becomes too heated too quick. And so they're just trying to slow it down. but usually the result is, we have these big movements, right? You get the strong inflation, you get the strong economy there, kind of rips up. And so, usually it's going to be a rip back down, just as the opposite move that happens. It's not that they want a recession. If the Fed could ever not have a recession, that would look amazing. But it's just that natural reaction. When you go up too fast, you're going to come down hard. And the question is never really if it's going to happen, it's when it's going to happen. So if we look at people that have been talking for the last 2 years about, we're in a recession, we're going to have a recession, we're going to have a recession for 2 years now. But we haven't actually, by any definition that's used out there, we haven't actually had a recession yet. And this is the important thing I think that people have to understand, because when we talk about economic policy, you have to have some agreed upon definition of whatever it is that you're looking to fight against or to encourage, right? Otherwise, what are you doing? And so, when we look at recessions like that, we're not there. Though, but it doesn't mean, life doesn't suck for some people, especially if you're lower down economically. Some of it's because people, as human beings, we tend to live beyond our means. We can look at credit card debt even prior to where it is now. It's actually pretty high right now. But even prior to when we kind of really took off here, people were still living, on credit cards. They're spending more money. They're using future dollars to live that lifestyle today, right? They got, 2 or 3 cars. They got multiple televisions. They've got, heaven forbid, all of us today, man, we're all paying for damn multiple Netflix and Disney,
Yeah.
and all those things, right? I'm old enough to remember cable. And when we had cable, we were all like, oh man, it's going to be so great when we get an a la carte type thing. But always the rub with that was always, well, when you have an a la carte, you're going to end up spending more money than you were with cable, right? Because cable gave you the discount for bundling everything together. You just didn't always get everything you wanted, or you got a bunch of stuff you didn't want. So when we look at that, so it's really important when we're talking about economics and economic policies that we have some agreed upon definition, right? So when it comes to, the big talking point lately has been Kamala's idea about price controls. And people are like, no, it's price caps. Well, no, that's price controls, right? You say, you can't raise prices above this level. That is a control on the price. The problem with this idea of price controls is that, or price gouging is what they're talking about, right? But price gouging isn't really a defined economic idea, right? It's this kind of, well, it kind of means this and this. It's a really kind of feely, mushy, emotional word, right? And you should always be worried when politicians want to use emotional words, because all of a sudden you say, well, what's price gouging? Well, this time it means this, right? Next time it might mean something a bit different, because there's no definitive, this is what it is. And that becomes dangerous when you're talking about, government involvement in pricing, because when you get in there, especially if you're somebody like Kamala who's never like really started a business, had competition against others, all these things, right? It's easy to go out there and say, oh, well, and I think just saw Senator Warren saying something about it too. All these greedy corporate, companies are holding prices up higher to kind of, to take it out on you guys, to just force you to pay it. But the reality is we're not seeing that. First of all, grocery stores have a 1 to 3% margin. That's it. That's razor thin margin. If you look further down the line to producers and whatnot, we're not seeing it either. The only people that are coming out really kind of saying that there's some kind of price gouging going on are these liberal think tanks, right? They're the only ones. But everybody else, whether they're conservative or whether they're neutral think tanks, are saying, listen, we're just not seeing this. We're not seeing that, right? It's the idea that we had bottlenecks, right? With supply bottlenecks coming out of the pandemic. We had the Russian-Ukraine war. For those of you that don't know, Ukraine is really important worldwide when it comes to food because of fertilizer and stuff coming out there, right? So all of a sudden, production's down there, so that makes it less available throughout the world, right? Prices are going to go up. And then on top of that, you had the government with their stimmy checks giving everybody all this money, right? Which, of course, is why then we saw the inflation going up, because you had all this money chasing after the same or lesser number of goods now. And so what we're having now are the hangover effects of all this. And so, when you talk about, trying to, when you sit there and you claim price gouging and you don't really have any proof of it, right? And you get in there and then you're like, that's okay. That way I can go in there because I'm going to be emotional, right? Again, and all politicians do this, guys. I'm just talking about Kamala right now because that's what this particular price gouging thing is, that's her thing. But all politicians do this. They reach out to your emotions because you buy, sell, choose, make decisions based on emotion. Just about everybody else, everybody out there does it. And so if they can come in here and use emotional words, then it makes it feel like, oh, you're being victimized and you're a victim and rah, rah, go government, protect me, right? This is what we do as far as, when you're in politics. And so, we get to this point now where she's out there saying, okay, well, there's price gouging going on. We're going to, institute price controls to save you, to be your savior, because otherwise you're going to get ripped off. And the reality of it is it just doesn't really work that way. When things are left to their own devices out there.
What does it look like in practicality? So I put a cap on, I don't know, wheat, whatever popular food you want to use. And I say, wheat is not allowed to go above $2 a bushel, or I could even just say like an apple at a grocery store, right? You can't buy an apple at a grocery. You're not allowed to sell an apple for more than $2 at a grocery store anymore. How does that impact the market?
Yeah. So again, you have competition, right? Everybody that's out there, has to compete for the same goods, right? The same services. So if the biggest thing that happens from it is if you are a smaller business, everybody's complaining about mom and pop shops going under and the big Walmarts and everything coming out there. Well, guess what, folks? If you come out there and you say, listen, there, you can't sell whatever it is for above this price. Well, you're going to price out a lot of your smaller competitors. So, your big competitors, your big chains, your big companies, your big corporates end up being the winner out of it because they can withstand that, right? Their profit margins are better. They got economies of scale. So, it costs them less to do these things that their smaller competitors do as well. So all you end up doing is you end up helping the bigger players out there. And what does that mean? That means you get less choices, right? All we have to do is look at you can even talk about the way food tastes today. I would argue food tastes a lot worse than it did 10 years ago, than it did 20 years ago, than it did 30 years ago. And I think, again, it's because, you basically get where you have these big corporations that are kind of pushing everything out there. And part of their reducing costs or whatever is they do everything the same way. And they do they cut these corners, they add this little bit in there, they do these things. And as human beings, we're worse off for it, and again, as your smaller companies go out, your mom and pops go out, it just becomes big corporations everywhere. The big corporations don't really get hurt as much by these types of things because, again, they got the economies of scale and whatnot.
And that's so funny. I always find that hilarious how they propose a policy to protect the little guy, but it ends up helping the big guy. And, not to be like too partisan, maybe partisan is probably not the right word, but I feel like they know that that's what happens. Like these aren't stupid people, right? So, it always reminds me of Dodd-Frank. And I always tell people Dodd-Frank was not a big banking bill. It was we're going to crush small to medium-sized banks bill, right? Because you create and it's like, I understand regulation in and of itself can be good, right? Although the best regulation for the financial crisis would have been to put people in prison, right? Like that would have been the best regulation in my opinion. But we get Dodd-Frank, and we think some of these people are heroes for regulating the banking industry, but it really just made it so that small to medium-sized banks could no longer operate because they couldn't afford the overhead and the regulation. So it was actually a pro-big bank bill. And so it's just funny how that same logic then applies to okay, you're going to set a price ceiling for food products, and you're essentially going to make it so that the bigger players are the only ones able to operate in the market. Which, is that really what we want? Because they're blaming the corporations for doing the price gouging. So why are we making it so that the corporations have more market share? What, it's essentially a reward, right?
Yeah. So I remember growing up, the big thing I always heard was, was this idea of a do nothing Congress is a bad thing, right? And so that kind of falls in, right? People in Congress, they feel like they have to be doing something. They feel like they have to do something, right? And if if Congress is doing it, it's about becoming involved, more involved, not less involved in things, generally speaking. And again, this is both sides of the aisle. This is every politician, right? And we have to think, what are politicians doing? Well, their job, right? What they're hoping to do is to get elected and then to stay elected, right? To get reelected. Again, as Warren and others have proven, Biden, it was this thing which was envisioned when the country was first started as being some part-time civic duty that people would do, get done, and then go back to their regular lives. And it's become actually a job now, right? It's become a career. And as it's become a career for politicians, it's created careers for support staff and everything else, and government continues to bloat. And so if you're running for Congress, then how do you get votes? You tell them, we're going to do these things for you. We're going to give you this stuff. And it doesn't matter whether it really turns things out the other way, because all you want to hear is this emotional, I got your back. I'm your bro. I'm going to take care of you. You ain't got to worry under me. And that's the idea. That's what goes on here over and over again. And most people don't even realize that they're falling for this, right? Because it plays on your emotions so well. Now, you're involved in politics. You've got this great understanding of politics. And so you understand the way in which they go out there and they frame things. You understand the way in which, that the different political parties will, post themselves to appear a certain way. And that's, for good, bad, or otherwise, I mean, that's what we're dealing with. And as long as people are left to believe that they're being duped by everybody but Congress, and the president and everything, as long as people continue to believe that you doing something for them is going to make their life better, they're going to continue to vote. And they have a short attention span, right? They don't remember. They'll go through 4 years and then they'll forget how it was. They'll go through 8 years, they'll forget how it was. And they'll keep doing that same thing over and over and over again. And then as we see, it just makes, Congress and the presidency and all, it's just these jobs, these careers, going around. Even Gensler, I should say Gensler. I say Gensler because there was this rumor going around that Kamala
he was going to get promoted. Yeah, under Kamala. I saw that.
Switched over to Treasury. But that's common. Again, we can look at Yellen. Yellen moved from the Fed to the Treasury, right? But you get these movements around within high level offices there in government. And so it just becomes hey, tell the people what we think they want to hear so that they're emotional and they believe us and they go and vote for us. And then, if it doesn't work out, we can still blame it on somebody else. We still blame it on something else. Oh, look, it was a split. It was, I said I was going to do all this when I became president. I became president. But, look, Congress was split 50-50, or there was slightly more of the other team in control. And so we couldn't get anything passed. So it's all their fault,
Yeah.
And that's kind of how we, get around through it all in there.
It's funny because even just going back to the price controls, it's one of those things that the people love and then the corporations love. So it's a good way to get votes and then get money so you can double dip.
Yeah. I mean, and again, it all comes down at the end of the day. It all comes down to if you're running for office, you're looking for a career move here. We want to get in. And here's the thing, even when you get out of office, well, now if you've been in office, especially if you've been part of some budgeting committee or something, all of a sudden when you get out, you get a consulting job as a lobbyist.
Yeah.
You're making, ridiculous, stupid amounts of money because you have connections, you understand how the inner workings are and everything. But that's how our government, unfortunately, is set up. It's set up for lobbying, right? So those who have the ear of the of the particular official are going to be the ones that get what they want passed. We can think back to if we look at it, we go, okay, well, we know that sugar, right? Sugar got replaced by what was that, cornstarch?
Corn syrup.
Corn syrup. Thank you. That's what I was trying to say. I knew you'd have the word. Yeah, that happened back in the 80s. Well, why did it happen? Well, because the corn syrup guys said, hey, listen, here's our lobbying money. Let's make it so that this becomes the thing that everybody's using. And we know today, we know how bad it is for us, but yet we use it. It's in everything, right? For me personally, if I'm looking at two things and I have a choice between something made with sugar, like real sugar, cane sugar, something like that, and something made with corn syrup, I'll take the cane sugar every day. Because, too much sugar obviously is bad for you, but any amount of corn syrup is bad for you. But again, this is the way it works. And, those of us out here voting that aren't, having the ear of these people in office, we're just kind of relegated to emotional reactions based on what they tell us because it just feels like, like we're getting screwed left and right.
Yeah. Well, do you have any kind of further comments on the market at all, Chris? I mean, those are kind of my two big talking points, but I want to give you time if you want to bring anything else up.
Yeah, let me pull up a couple of charts here real quick.
Yeah, please.
Let me get this loaded back up here since I had that other screen on.
What charts are you going to be looking at? Are you going to be looking at the Bitcoin charts or some futures?
Yeah, Bitcoin futures, the VIX, the DXY, a few general charts like that here. So if you'll pull it up there, I've got the DXY on there, and as you can see, we've got what is actually what we call a diamond pattern here, right? So you get this consult below that. So those that like patterns, they can look at that and go, oh man, yeah, that's here we go breaking down here. Again, me, I'm looking at this as an AB or a 2 here. I've got it as a 1-2 because I'm thinking that's probably where we're headed with it. But again, as it comes for the weekly right here, this is the weekly pivot. We're breaking down below it there, and we're breaking down below it on some volume here as we're kind of getting here. And here's some follow through. So it looks like, ultimately, we'll get a little bit drop and then we'll get a rally up. We'll probably get rejected right around that 102.5 area. And then, my expectation is that we'll kind of continue down lower here and continue down. So the dollar, I expect to weaken out there. Weaker dollar makes, for when it comes to your economy there, that weaker dollars, what they're looking to do, when you're raising that interest rate, right? Well, when you raise the interest rate, it goes up. When you loosen it, comes down here. Yeah. And so, as the dollar weakens, that's going to make your assets like Bitcoin, stocks, and whatnot, it makes them more risk on, which means because the value of the dollar is going down, so it takes more dollars to buy them, which increases their price, right? It increases their value. And so that's kind of what we're looking for here. So, my expectation is that we continue coming on down. That we continue on quite a bit overall. We've just been in this sideways thing basically here since about January of 23. So, we're going on well over a year and a half of just sideways here. And now we're kind of breaking down. So I'm looking for that to continue down further. Again, with the dollar coming down, we should expect, asset prices to go up. Generally speaking. And so if we jump in here, let me see here. We can look at the VIX. The VIX, we had the big spike here.
That was during the
right there around, was around 65, 66. Yeah, that was that Monday. That was August 5th, right? But look at how far we had this big drop down to 14 and some change down here, almost 14. Absolutely mega drop. We've never had, let me turn off the S&P over here. We've never had such a significant drop. If we look here, if we look all the way back through here, we can get all the way over here. Well, let me zoom into the weekly here. If we look all the way back here to 1990, even we've had these spikes, they've always come down a bit, bounced, and then came down further, right? This has been a decent move down. On a bigger time scale, This is the height of the GFC here. And so this would probably be the closest to what we have here. But even here, you can see it's significant. It's been a significant pullback. And so what does this tell us? This tells us that the market isn't quite so worried. The market was freaked out up here, but now we're way back here below 20. Market's not so concerned. So they're ready for risk on. And so what have we seen since this? Is we've seen the S&P rally up, right? So the S&P has jumped up there. Let me see if I can get it on this. No, that ain't correct. Let me see here. I don't have my S&P chart, but they're pretty close back up here to the all-time high. Big V-shaped recovery off that. So, again, if you're looking, when you're in the markets, you're looking for probability. What's more probable, not what's possible, because anything's possible, right? It gets you gummed up in there. So you got to look at what's more probable. Well, right now, with the VIX continuing to drop off like it has, and we're almost at the new, it suggests that we're most likely going to break out higher and continue to rally. We can look at NVIDIA, which has broken. It's rallied up since that same day there. It's rallied up about 43.25% already up there. Looks like overall, like we're going to break out and head higher. We can look at Meta. I've got a lot of things on here. I'm going to get rid of some of this here. Meta is just right now sitting about 2.6% off its all-time high right here. So again, coming off, the August 5th here, which it was already in an uptrend. You see, it was already in an uptrend and pulled back up there. But just from August 5th, it's rallied up. You see here. Up here, about 19.5% off that. And by the way, it's actually been on the uptrend since down here on April 25th, right? So it was an uptrend, pulled back. It's continuing to move its way up there. So you're getting these really big, at the upper end of the market cap companies here that have just continued to rally, and they're nearing those all-time highs again, along with the indexes. Now, something interesting here is this is copper futures. And copper futures are looking kind of interesting here. So we had this big rally up here into May of 24, right? If we look back here. And then we've had this big move down, which so far is in three waves here. But it's possible that copper may have important. Well, it's important. Those that are in the markets, they call it Dr. Copper, right? So basically the idea is if copper is going up, copper is used in so many manufacturing things that if the price of copper is going up, there's more production going on, generally speaking. So if this is a bottom for copper here, we get up here, maybe get a little pullback, and then we get this break, continue pulling up. Well, it's hard to say that the economy is going to be in a recession because production is increasing. Usually that's a good sign, that your economy is going to continue further, right? So, again, when we're looking at this, potentially a breakout here, that would be the first thing I'd look for. It's a breakout about 4.22 area up there, depending on how long it takes to break out. But man, if we can get broken out here above this swing high at 4.6995, that should indicate we're going to head up with higher copper prices, continue to push up there. So, and then we jump here in Bitcoin. And just to keep it simple here, this is where we're at, right? We haven't had any significant movement yet off this drop here. Again, remember, basically the way I'm looking at this, so you got a 1, 2, can do this here, 3, and potentially 4 being done here with the idea that we've got a, I didn't do the thing. 1, 2, 3, 4, and then 5. And then basically we're looking at 3 waves down, 3 waves down. What we call it is a WXY on that correction. And so, the important thing about the most important thing about this particular account, besides, that the potentially it's a WXY, they're coming down, is that it pulled back. See if I can get set here. 38.2%. And so fourth waves generally pull back 38.2%. If they go lower, the secondary target is the 50%. And that's why I keep saying if we're getting this move down to 42.5, 43,000, even then, to me, it doesn't suggest that this is the top of the cycle. It suggests that that's still a bigger wave 4 in progress, which will give us a larger wave 5 target. So, again, when we're looking here, all we've really done is just kind of go sideways here between, a little bit above the R2 pivot, a little bit below the R1 pivot, just this sideways here. Large wick, large volume. We like to see that. Now we want to see some breakout higher. Now, that doesn't mean we can't maybe pull back into this wick here. A lot of times we'll do that. We could maybe pull down here to 54,000 or so. That would probably be a pretty decent area, maybe even 53,000. Wouldn't be surprised at all to see that. But if we're rallying up here and we're getting above this last lower high up here at around 70,000, at that point, there's no reason you should be thinking lower. If you want to be skeptical right now, that's fine. Do your thing. But once we break out above that, you really shouldn't be thinking about lower. Based on the Elliott Wave, once you get a little bit higher here, it's 71,900 and change. At that one, that Wave X swing high, you definitely shouldn't be thinking lower. But what happens at these points are people are skeptical, no. And then it gets up here and then they're like, oh, damn, I should have gotten in already. Why did I wait? Oh, man, And that's kind of, as trader investors in the market, that's what we kind of go through, right? It's the idea of how much risk are you willing to take when you're in a trade? And if you wait for, the significant levels like those I talked about, you're going to be taking on a lot less risk, but the less risk you take, the less reward you're going to get out of it. It's just, you have to figure out when you're in the markets, how much your risk tolerance really is to figure out how much risk you're willing to take in return for that profit you're looking to hopefully get.
I was looking at the Bitcoin chart earlier. Of course, yours looks far better than mine, right? Because I don't have any of the lines and don't understand charting analysis near as well as you do. But I'm just curious how much longer you think we're going to be in this sideways pattern. I mean, that would probably be, I guess, my final question to you. If you had to predict, which I know it is a terrible question, right? But like traditionally, I mean, do you think we could this last until the end of the year? Could we go past into January?
Oh, timing is such a hard question, right?
Yeah.
I wouldn't think so. Unless we were to maybe break down to the 50%, I wouldn't think so. This sharp move down right here and this rally back up, I would think that if this is wave 4 as we have it here, my thoughts is that we should be hitting a new all-time high, maybe sometime in September, as it plays out there. That would probably be my best guess. But don't really put any stock in that, folks. I'm terrible at figuring out timing. 30 years of doing this, I figured out that's something that very, very, very few people ever get anywhere decent at, and I'm awful at it. But if this is the low, though, I don't believe that we should have that we should continue on the end of the year. My only thought with that would be if this was actually to play out as a triangle, that would be the one caveat I'd have. So triangles come in wave 4s, and there are 3 wave patterns, right? So it's an A, B, C, D, E pattern. So we go like A, B, C, D, E. And with this, each wave here is 3 waves. So WXY is 3 waves. So we could potentially see maybe like A, B, C for a B, A, B, C for A, B, C, yeah. And then D, and then maybe, E, where you end up getting this triangle going on here instead of that wedge there. This is still possible. And that would be the only way. Now, I've got it drawn all the way out here to March, and it doesn't be long. But that would be the only way that I would believe that we would continue sideways into the end of the year, potentially January, would be if we were building just some huge freaking triangle.
Gotcha.
But here's the thing about that. The longer you go sideways, the longer you consolidate sideways, the larger and the stronger your breakout is going to be. So, if we were to do that, maybe into the end of the year here or further, again, I don't think that's what's going to happen, but we got to keep it potential, until we get some other notification say it isn't. But that don't sleep while you're there. Get out there and buy more Bitcoin, make some more money to put into Bitcoin, because that rally out of it should be absolutely insane if it was to happen.
I think that's a pretty darn good note to end on. Do you have any closing comments? I mean, buying Bitcoin now seems like a pretty good one.
Yeah, again, I'm just in the longer term thesis. I'm a believer in Bitcoin. So, if you have that longer term thesis, it doesn't matter whether you buy today at 60 or you buy next week at 55 or something. If your thesis is, hey, we're going to 2 or 300,000, or in 10 years to $1 million or something more, that $5,000 isn't really going to be all that much, of a difference, especially if you're not really well referenced with the markets and, how they're doing things they're doing. You just kind of get in, you find a way to make more money so that you can buy more Bitcoin. If you're trading it, well, this is where we start watching the levels, again, on the larger time frames. I told you what we needed to kind of watch, but you take on a bit more risk. Traders are shorter term. You're going to look to get larger profit in a shorter period of time. You got to take on more risk. So just understand what you're doing when you're out there, and understand that in life, not just in politics, but in life, in markets, you are beholden to your emotions. So, you can swear up and down that you're that you're being logical in your purchasing decisions. Again, whether it's a car or a house or whatever, or what level you're buying in at on a chart. But at the end of the day, if you're honest with yourself and you really look at it, most of the time you're emotional, and it's tough. It's tough. But you have to get a control on it, for life to be this great thing that you want it to be. As long as you're beholden to your emotions, life's going to be tough.
Very well said. Very well said. Well, everybody, thank you for tuning in. Thank you, Chris, as always, for helping me co-host. Really appreciate it. Always appreciate the knowledge. Really helps me a lot. It seriously does. And guys, you'll see us tomorrow, hopefully around the same time, noon EST. And hopefully maybe Gary will be able to join us if he's not too busy networking. But otherwise, you'll be stuck with me again. And once again, if you're in Jackson Hole, Wyoming, feel free to say hi. We are here. We're at the SALT conference. Happy to meet you guys. So until next time, thanks, Chris. As always, we will see you guys tomorrow.
Appreciate it, man.